This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to another episode of the Value Investing Podcast. In episode 58, we talked about John Templeton and his 16 rules. What we did there is talked about the first 7 rules with respect to John Templeton. And what I'm going to do is talk about the rest of the rules that he had. And as I mentioned in the last episode, he was legendary value investor and he was able to accumulate huge returns for his clients when he was managing Templeton Fund. So what I'm going to do is I'm going to review the rules and principles by John Templeton, and it's going to be very exciting and fun. And I want to just go over some of his rules that we discussed in the last episode, and we can get into the rest of the rules in this episode. But before I do that, let me give you a quick disclaimer, as always, that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? John Templeton was a legendary value investor. You can look it up online and you'll find a lot of amazing stories related to John Templeton. And he was quite similar to Warren Buffett in many regards, but as you listen to his rules, you'll see some differences and you'll see some of the divergence from Warren Buffett and Peter Lynch. But I think it's important for us to dedicate some time for this value investor because he was quite successful. And I think we can learn quite a lot from him. So what I'm going to do is I'm going to just go over 7 rules that we discussed last time, and then we can just dive into the rest of the rules. Number 1, invest for maximum total real return. Number 2, invest, don't trade or speculate. Number 3, remain flexible and open-minded about types of investment. Number 4, buy low. Number 5, when buying stocks, search for bargains among quality stocks. Number 6, buy value, not market trends or the economic outlook. Number 7, diversify. In stocks and bonds, as in much else, there's safety in numbers. So those are the 7 rules we discussed in episode 58. So if you haven't listened to that episode, then you can just go there and listen to that first, and then you can come here and listen to the rest. But they're not related to each other, so you can listen to this one first as well. So why don't we go to rule number 8, which is do your homework or hire wise experts to help you. This is similar to Peter Lynch to a certain extent, because what you have to do before any investment is do your own homework, because without knowing much about where you're investing and why you're investing, you're going to be vulnerable to many pressures from outside. Because let me just give you one quick example. If you see market drop, or if you see significant drop in your stock, in your portfolio, then what's going to happen is that you're going to be influenced by the drop, and you're probably going to feel the need to sell that stock at the wrong time. That's not what you want to do. So just do your own homework, and if you have good understanding about the company, and if you feel that the drop is just due to market fluctuation, has nothing to do with fundamentals, then it's wise for you to hold on to that stock and just ride through all this market turbulence. And that's a really good point, because if you don't do your own homework, then you're going to be influenced by all this market fluctuation, and you're going to probably buy the stocks at the wrong time and also sell the stocks at the wrong time. And he gave out some useful content here within this rule. He said that, remember, in most cases, you are buying either earnings or assets. In free enterprise nations, earnings and assets together are major influences on the price of most stocks. What he means by that is either you buy future earnings when you're investing. If you think that the future earnings will grow, then you buy into that stock. Or if you think that the company that you are trying to invest has a lot of assets that are valued higher than current stock price, then you can buy and potentially liquidate the entire company. Then you still will be left with a lot of money. So that's when you buy into assets or you buy into future earnings. My preference lies in the area of future earnings because that's ongoing profits that company can make, whereas assets could be only sold at one time. And the management team may not even sell their assets against investors' wish. So it's always to look at these two different views, but my preference lies in the area of future earnings. So that was rule number 8. So just do your own homework or hire wise experts to help you. So the bottom line here is that you need to have good understanding about the company that you're investing in. Let's move on to the next rule, which is number 9. Aggressively monitor your investments. I don't know if this is necessarily going to be good advice for certain people. So let me just tell you what I mean by not good advice. Because here what John Templeton is saying is that there's no permanent bull market. There's no permanent bear market. And there are no stocks that you can buy and forget. And he's saying that the pace of change is too great. And if you're just relaxed and forget about the stock, then you're probably going to face the situation where the stock may actually go bankrupt or the stock can be acquired by other companies. So if you look at a list of stocks in S&P 500, let's say 30 years ago, you're going to have completely different list. Right now, if you look at it, even 10 years ago, we had a completely different list of companies there as opposed to the list of companies that we are seeing right now. So he's saying that we have to aggressively monitor your investments. The reason why I'm saying that this may not be good advice for certain people is the fact that people are very short-term oriented. So they have to be very patient in order to gain long-term returns in many cases. So if you're not patient, if you aggressively monitor, for example, your investments on a daily basis, I think that's going to be detrimental to your health and detrimental to your portfolio returns because you're going to have more turnover over the long term. So my preference is not to look at portfolio and my companies every day, but maybe just look at it once in a while, maybe every quarter when the earning is released, or maybe every year when you can see seasonality and also the full year performance. Because if you look at every day, then you're not going to be able to gain anything. You're probably going to find a lot of negative news and you're probably going to sell the stocks at the wrong time. So I want to just take a step back and take it easy when it comes to assessing the company, right? You're going to see a lot of news and you're going to be influenced. And if you are type of person who tend to sell stocks at the wrong time, just take a deep breath and just take a step back and try not to look at all this negative news and all this even positive news. You just take a step back and try to only make money from the long-term gains and long-term returns on the profits or earnings. So let's move on to next rule. Next rule is don't panic. I think this is quite relevant for the current stock market because of tariffs and also the trade war between China and the US. And there's a lot of turbulence in the market. So during these times, I think investors should actually keep themselves calm emotionally. Otherwise, they're going to be influenced and sell the stocks during this panic time. So what I do is I look at my portfolio, but I try to detach my emotions when it comes to looking at my portfolio entire total net worth. And also I try not to look at it every day. That's actually related to what I said about checking the stock price and checking your portfolio every day. So don't panic. And it's probably a good time to buy more if you see the stock market drop. And it's also possible we may face the risk of having recession sometime soon because we have had very long bull market over the last 10 years from 2008. And it's actually been more than 10 years, but we could have recession sometime soon. But the U.S. market has always recouped all the losses that during the recession. If you look at the long term, like more than 10 years or 20 years, we were always be able to come out of recession strongly. So I think that this time would be the same given the nature of the economy and how we operate within US. And a lot of companies are very competitive, and we have very flexible labor policy. And all things considered, I think we're going to come out very strong. So with that said, I think it's important for us to not to panic during the market crash and not to panic even if we are in recession. So at least that's the behavior and attitude that I adapt during these hard times. And I don't know, you may have different approach, but at least that's my approach because I'm a long-term investor. I'm a value investor. In order to make money from value investing approach, you just have to be very, very patient. So just try not to panic during any time periods, because once you get emotions involved in the process of investing, then it's likely that you're going to make a mistake. So the next rule is learn from your mistakes. He said the only way to avoid mistakes is not to invest, which is the biggest mistake of all. So if you don't invest, you can probably look at people around you, and a lot of people think that stock market is very risky because there's just a lot of ups and downs every day in the stock market, and they've seen some of the scary bankruptcies in the past, and they have certain image about stock market. But if you look at the long term, again, long term, more than 10 years, 20 years, the stock market has produced quite significant return over other investment assets. For example, if you invest your money in 10-year treasury bond or 30-year treasury bond, probably the return you're going to get is 3% at the maximum. But if you invest in stock market, you can get returns well over 6%. So that's quite large over a long-term time period. So if you don't invest in the stock market, then you're missing out a huge investment opportunity. And that's what John Templeton is saying here. The biggest mistake is not to invest. Also, he's saying that things actually repeat over time. So if you look at history, then you're going to learn what's going to happen in the future, and you're going to be able to learn from your mistakes. So if you think that you have made mistakes in the past, then assess those mistakes in an objective manner so that you don't make that mistakes again. I mean, that's exactly same as other things in life. So that's what he's trying to say here. And then a lot of investors are saying that this time is different. This time is different because of economy. This time is different because of this, because of that. All these things should be put in the sideline. You shouldn't pay too much attention to what these naysayers are saying, but stick with your principles, stick with your investment rules, stick with whatever methodology you have, and you'll come out strong. And that's just my opinion. And also that's what John Templeton is saying here. And he said the big difference between those who are successful and those who are not is that successful people learn from their mistakes and the mistakes of others. Okay, so the next one is rule number 12. It says, begin with a prayer. If you begin with a prayer, you can think more clearly and make fewer mistakes. If you're not religious, then you might think that this is not relevant for you, but I don't agree with you in a sense that if you do meditate, then you probably will be able to keep yourself calm emotionally and should be able to invest better because you can detach your emotions. Because when you see, let me just go back to that example of stock market drop. Let's say your entire portfolio goes down by 20%. Then you're going to feel pain in your gut, and if you're going to feel very painful emotionally about the whole situation, then you want to get out of that emotional state, and you're probably going to sell some of the stocks in your portfolio at the wrong time. But if you know how to meditate, if you know how to do the meditation correctly, you should be able to keep calm and can ride through all this market turbulence. And that's what I mean by learning something from this rule number 12. You don't have to begin with a prayer, so to speak, but you can definitely practice your meditation and whatever techniques you have. Maybe you have to take a deep breath and try to keep calm and try to detach your emotions. And all these things are very helpful, because once you click that mouse, then you're going to be able to sell your stocks, and you're going to feel free from all this anxiety and also huge pressure, financial pressure. But if you see the stock going up again and recoup some of the losses in the future, then you're going to feel pain again. So let's not make the mistake. But also, when it comes to selling stocks, you have to look at the fundamentals. And if you believe that fundamentals are the main cause of the stock price drop, then that's the time you might have to assess the situation and can sell some of the companies in your portfolio. But just don't react to huge drop in stock price emotionally. Just make the assessment objectively and make the decisions afterwards. So that's what I'm trying to say. The next rule is number 13. Outperforming the market is a difficult task. I think everyone knows about that, but people, even if they know that outperforming the market is a difficult task, people do not really appreciate the importance of recognizing this one. Probably I'm actually in that category as well, because if I think that the market is going to perform well and I cannot outperform the market, there's no point of me trying to pick individual stocks. But I just enjoy this process. I know that I may not be able to beat the market in the future, but I enjoy picking the stocks, individual stocks by myself, and I enjoy the feeling of investing in the companies that are making contribution to the community and also society, and also I feel like I'm part of big thing. So it's not necessarily profit and making money in my case, and I think that it's just really good hobby for me to do the research and understand the companies, and also doing this type of podcast and sharing ideas about different companies and so on. So that's just where I'm coming from. But if you think that this is a waste of time because you think that you're not going to be able to find time to do the research and beat the market, then I think the best way for you to invest is just invest in S&P 500 or in the index that actually captures total universe of stocks and something like that. John Templeton said that any investment company that consistently outperforms the market is actually doing a much better job than you might think. The reason why he's saying this is that a lot of investment companies have to have some cash on hand, and that's a huge disadvantage compared to S&P 500, for example, because the S&P 500 is always 100% invested, whereas if you look at other money managing firms, then they need to have some cash on hand in order to redeem some shares or redeem whatever money they have for their clients. So that's a huge disadvantage. And I have something to say on that front, because my strategy has been always 100% invested in the market. So whenever I have some income, whenever I have some money, I try not to just sit in my savings account. I definitely put some emergency funds, enough to cover any emergency situations. But aside from emergency funds, I put all of my money in the stock market 100% all the time. That strategy has worked really well over the last 10 years because the market itself has come a long way in terms of producing a lot of returns. But it may not work during recession, it may not work during market crash, but I'm willing to experience this market crash and portfolio paper loss during these times, and I'm just going to put my money 100% invested all the time, because I know that I cannot predict exactly what is the timing that I need to invest and what is the timing that I need to sell my shares. So if I cannot predict the timing, if I cannot time the market correctly, why not just have my money 100% invested all the time? So that's just my strategy. People have different strategy, and try to see which one works and makes most sense to you. Some people use like 80-20% rule. So they always invest 80% of their money in the stock market and always keep 20% cash. So they rebalance their portfolio every now and then, let's say every month or every quarter. So if the market goes up and down a lot, then that strategy is going to work well, because you tend to buy at when the market is low and you tend to sell when the market is high. But my strategy is just have my money 100% invested at all time. So I don't have to worry about market going up and down, and I don't have to worry about, selling or buying at different time periods. But study all these different strategies about how you want to rebalance your portfolio, and also you may have different strategies of rebalancing your portfolio between different asset classes, and that's a whole another topic that I can cover in different episode. But this is very important topic you need to determine by yourself, and also you have to think about your own situation and see which one fits the best in your case, because people have different preferences, and also people have different needs for their financial situation. So I cannot just say that you have to do one thing for everyone. There's no one size fit all approach in this case. The next one is rule number 14. It says, an investor who has all the answers doesn't even understand all the questions. This is interesting one, because if you look at any financial media, for example, Jim Cramer. I love Jim Cramer and I like to listen to his shows, but he's type of person who answers all the questions. I've never seen him saying that, I don't know. But how can you understand, let's say, more than 100 companies? I think he can answer any questions that you're asking during his show, and maybe he has some knowledge here and there, but I don't think that he can have deep knowledge in any individual stocks if you want to cover every stock in the market. And that's what he's doing. He's super smart. There's definitely no doubt about that. And I love Jim Cramer. But just the fact that he can answer all the questions doesn't necessarily mean that they're right. So try to be careful when it comes to, assessing other people's advice, including mine. So I try to give out good advice to the extent possible and to my best ability, but I might not be able to provide the best advice in your situation. So that's why I said during disclaimer that this podcast is for just entertainment purposes only. And you have to talk to your investment professional just to see what advice fits best for you. Number 15, there's no free lunch. John Templeton here said, this principle covers an endless list of admonitions. Never invest on sentiment. The company that gave you your first job, or built the first car you ever owned, or sponsored a favorite TV show may be a fine company, but that doesn't mean its stock is a fine investment. Even if the corporation is truly excellent, the prices of its shares may be too high. I agree with this point. There's no free lunch. You can try to do the assessment on the company. If the company has great outstanding business model and also company has outstanding management team, it's likely that the price of the stock might be too high. That's why you see from a lot of technology stocks these days, because their business models are excellent, but the prices are too high. So I never actually invested my money there. So because I care about intrinsic value, I care about margin of safety, so there's no free lunch. But if you look at undervalued stocks, let's say by some financial metric, for example, price to earnings ratio, then if you look at stocks with low price to earnings ratio, then you tend to see the companies that are in decline, or you tend to see the companies that have very gloomy picture in the near future. So you have to know how to differentiate a good company from bad companies, but also at the same time, how do you compare the quality of that company against the value that you're assessing and also the price that you're looking at? So that's really hard question. So there's no free lunch. You have to do your own homework to find out undervalued companies. And also you have to make assessment whether or not the price makes sense and also whether or not you have good understanding about the future of that company. So definitely it's not easy game, but it's enjoyable. I truly enjoyed this game. If you are in this game and try to do your own homework and try to beat the market, you may not be successful, but at the same time, you might enjoy the process of doing it. You might be learning quite a lot from business perspective. So there are just a lot of intangible benefits that you're going to get from this process, and that's what I like. The last rule here is number 16. Do not be fearful or negative too often. I completely agree. I already mentioned about some negative news coming out all the time for individual stocks, and you probably would see stock price going down by 20%, 30% on negative news. And they might be legitimate drop, I'm not saying that all these drops are bad, but in many cases, the market react more than necessary and more than that could be justified. So you have to be careful not to react too negatively and also not to be too fearful when the market reacts that way. Because I feel that there's emotion attached to the market, and you need to know how to differentiate between actual legitimate market crash versus just the fear revolving around the situations on that company. Okay, so we talked about 7 more rules with respect to John Templeton. As I mentioned, he was legendary value investor. We can learn quite a lot from him. So I feel that this episode is going to add a lot of value given the current situation that we are facing in the market. We are facing some difficulties to negotiate with China on tariffs and trade war, and also there's just a lot of uncertainty in other countries, and also we're gonna have new presidential election next year. So there's just a lot of uncertainty, but trust me, there's always uncertainty in the market. It doesn't matter when you actually try to make assessment, there's always uncertainty in the market, and we should love to invest given this uncertainty, and uncertainty will exist whenever you try to invest. So thank you very much. And the only thing that I want to ask you to do a favor, which is just leave a rating and review if you find this podcast interesting and helpful. And that's going to attract more people and more value investors. And my goal is to create this value investing community, and we can make healthy and good investment decisions, and we can potentially become financially independent at some point in the future and try to make the best out of all these lessons that we can learn from legendary value investors. Thank you very much, and see you next time.